Hey there fellow traders, Yunus Usta here. In today's video we're diving into market imbalances. What they are, how to spot them on the chart, and what they mean for your trading strategy. By the end of this video you'll have a clear understanding of how to identify imbalances and use them to make better trading decisions. Let's get started. Ever see a stock make a crazy move out of nowhere? It's like watching a roller coaster suddenly drop. That's often imbalance in action. It happens when there's a sudden shift in buying or selling pressure. It's like a tug of war, but one side is way stronger than the other, pulling the rope with overwhelming force. In trading, this happens when buyers or sellers completely overpower the other side, creating a significant shift. This causes the price to shoot up or down rapidly, leaving a noticeable gap on the chart. Think of it like this. You're at an auction for a rare Beanie Baby. The room is buzzing with excitement. Everyone expects it to go for $100, but then someone screams $1,000. The room goes silent. No one else bids. Boom! Imbalance! The price jumps without any competition. The price jumps with no real fight, just like in the stock market. In the stock market, these big moves often happen because of the big boys, the institutional investors. They have the power to move markets. They're like the whales of Wall Street, throwing around huge amounts of cash and creating waves. When they make a move, it creates an imbalance that smaller traders feel. It's a ripple effect that can impact everyone in the market. Now, how do you spot these imbalances on your trading charts? Look for big, fast moves on the chart. These rapid movements often indicate a significant imbalance between buyers and sellers. These are usually long candlesticks with very little wick, the thin lines above and below the candle body. Long bodies with small wicks suggest strong momentum in one direction. It means the price moved quickly with little resistance. This lack of resistance is a clear sign of an imbalance. Another telltale sign is a gap in the chart. Gaps occur when the price jumps from one level to another without any trading in between. This is literally a space where no trades happened. It indicates a sudden shift in market sentiment. The price just jumped over it. This sudden leap can be a strong indicator of an imbalance. This is called a fair value gap, FVG. FVGs are important because they highlight areas where the market has moved too quickly. It's like the market skipped a beat. These gaps can often be revisited by the price later on. Pro tip: use a volume profile indicator. This tool helps you see where the most trading activity has occurred. This handy tool shows you where most of the trading action happened. High volume areas can act as support or resistance levels. Imbalances often show up as areas with very low volume, like a ghost town on your chart. These low volume areas can be potential reversal points. So why should you care about imbalance? Because the market hates imbalance. It always tries to correct itself. That means those gaps we talked about, they tend to get filled eventually. Think of it like a stretched rubber band. It wants to snap back to its normal shape. That's what the market does with these imbalances. And that snapback can create big trading opportunities. Plus, imbalances often happen around important price levels. These are areas where the smart money has placed their bets. The support and resistance zones. So, if you see an imbalance near one of these levels, it's like a flashing neon sign saying, "Hey, pay attention here." Now, you're not going to get rich just by spotting gaps on a chart. You need a plan. Gaps can be tricky, and without a solid strategy you might end up chasing shadows. One way to trade imbalances is to wait for the market to retrace. Remember that rubber band? When it stretches too far it has to snap back. After it snaps back it usually bounces a little. This bounce can be your opportunity to enter the market at a better price. So, after a big imbalance move, wait for the price to come back towards the gap. This is where patience pays off. Look for signs that the momentum is shifting, candlestick patterns, volume changes, etc. Then, pounce. These indicators can give you the confidence to make your move. But remember, even the best traders get it wrong sometimes. The market can be unpredictable and no strategy is foolproof. That's why risk management is key. Protecting your capital should always be your top priority. Always use stop-loss orders to limit your potential losses. This way, you can safeguard your investments against unexpected market moves. That way, even if the market throws you a curveball, you'll live to trade another day. It's all about staying in the game, so there you have it, folks. A simple, yet effective approach to trading with imbalances. Imbalance trading in a nutshell. Remember, it's all about strategy, patience, and risk management. If you enjoyed this video, be sure to check out our other videos. You're going to love them too. As always, thank you for your support.